HSBC's performance dips in the wake of $1.8 billion misconduct settlement. Thank you for joining us for another Bank of Cardiff newscast. It never rains, but it pours. HSBC bosses must surely feel as if they are caught up in the mother of all storms, as Q3 results torpedo the bank's chances of achieving its targets on the cost of running the business in 74 countries, largely due to the expense of bringing on board yet more legal staff in an attempt to avoid further damaging encounters with regulators. HSBC announced lower than expected profits for the third quarter after it had to set aside $1.8 billion for misconduct settlements and compensation for customers, including a potential fine for rigging currency markets. The bank is feeling the impact of regulators' efforts to eradicate the bad behavior in global banking that fueled the financial crisis, not least in the costs attached to increased internal regulation. HSBC has spent $700 million more this year on compliance and risk than it did last year, a cost that seems likely to persist. Well, Stuart Gulliver, HSBC CEO, said the cost base of a global bank like ourselves is higher than it was before. It includes significantly higher compliance and regulatory costs than historically the banks had invested in. Well, HSBC is one of 6 banks in talks with the regulator to pay what sources estimate to be around $2.4 billion in a coordinated settlement for rigging the $5.3 trillion a day currency markets. It's made a $378 million provision for the Forex investigation, $589 million to compensate British customers who were missold payment protection insurance products, and a $550 million settlement in the US for mis-selling mortgage-backed securities. The bank said it faced a fine for breaches of, quote, systems and controls in its currency arm by the Financial Control Authority, or FCA, but insisted that the $378 million did not relate to penalties to be imposed by other jurisdictions, particularly the US, with which it has a deferred prosecution agreement, or DPA, relating to a $1.9 billion fine 2 years ago for money laundering breaches. HSBC has had to increase its provision to compensate British customers for payment protection insurance mis-selling due to a very significant step-up in claims made by claims management companies in August and September. Its provision was lower than the $800 million set aside by Barclays and $633 million by Royal Bank of Scotland, which may have also set aside cash for settlements with other authorities. Banks in Europe and the United States have recently set aside as much as $6.9 billion for possible Forex settlements. HSBC has previously warned that the fear of fines is forcing banks to become more risk-averse. Chairman Douglas Flint said in August this year there was growing fatigue in some of the bank's operations on account of staff having to work much longer hours to implement system changes. Although he admitted that a more robust focus on conduct was the right response to the problems of the past, he also said that unwarranted risk aversion threatens to restrict access to the formal financial system to many who could benefit from it, and risks unwinding parts of the economic system of networks and relationships that support global trade and investment. Well, the changes include ring-fencing retail and investment operations, a process the bank claims will cost hundreds of millions of pounds each year. Politicians have called for an electrification of the ring fence with a threat to break up banks if they fail to comply. So, what next? Well, the ripples seem unlikely to stop spreading yet. HSBC has also been summoned to appear before French magistrates over the issue of whether its Swiss private bank had helped French citizens to evade tax, and it could face a criminal investigation here too. HSBC's third quarter underlying earnings fell 12% over 12 months to $4.4 billion, with operational expenditure jumping 15% in the same period. Its aim of reducing costs to 50% of revenues by 2016 now looks increasingly likely to be missed. Leslie Chanel, credit analyst at Bank of Cardiff, commented, "Banks around the world remain mired in regulatory and compliance obstacles that show no signs of abating 5 years post-crisis. This will continue to cause a disproportionate amount of pain for smaller customers, including Main Street businesses that simply don't fit into banking's current risk-averse reality. Well, join us later this week for another Bank of Cardiff newscast, and remember that all of our newscasts are available on our website, and that's www.bankofcardiff.com/newscasts.